Natural gas futures are taking a step back for the second day in a row as traders digest a storage report that didn't quite meet expectations, raising fresh concerns about supply. On top of that, shifting weather models are adding to the uncertainty, with temperature forecasts bouncing around and influencing market sentiment. Thursday's EIA report showed an 80 billion cubic feet withdrawal, falling short of the 92 billion cubic feet draw the market was expecting. This weaker number was partly due to an uptick in solar power output, which cut down on natural gas demand for electricity generation. Solar energy generation was strong last week and significantly higher year over year as additional capacity has come online. It will be interesting to see how wind and solar perform this shoulder season, especially with expectations that they will contribute more than last year. Looking ahead, weather forecasts suggest only moderate gas demand over the weekend, with a mix of chilly and mild conditions across the U.S. While colder air sticks around in the northern states, temperatures in the south and east, ranging from the 50s to 80s, are expected to keep heating demand in check. This back-and-forth temperature pattern has made it tough for the market to sustain any real bullish momentum, even though supply remains relatively tight. Right now, natural gas is caught between two opposing forces, lingering supply concerns after a cold winter and the reality that the season is winding down. As we shift into warmer months, demand is expected to drop off sharply, leading to a quick buildup in storage levels. And here's where things get interesting. After yesterday's storage report, there's been a noticeable bearish shift in storage dynamics. As shown in the image, the once widening deficit has now started to shrink, going from minus 290 to minus 205 billion cubic feet, much lower than last week's estimate of minus 320 billion cubic feet. Moreover, today's update revealed an even sharper decline in the deficit, which is now expected to shrink to minus 176 billion cubic feet, an even faster contraction than previously anticipated. And this is truly remarkable progress. Just in 1 week the storage deficit is projected to shrink from minus 320 to minus 176 billion cubic feet. That's a stunning shift in such a short period. That's a big deal because the expanding deficit was one of the key bullish drivers in recent months. With that no longer in play, the market could be in for a shift in sentiment. Last year, when prices plunged to multi-year lows at the end of winter and early spring, U.S. gas producers cut production levels and rig counts, waiting for higher prices. At the same time, they were building up inventories of wells, keeping them ready to start pumping or be brought online as soon as prices rebounded. Nevertheless, I have to express some skepticism for the bears. Despite increasingly bearish fundamentals, the market remains under the grip of speculators betting on Donald Trump's potential tariff war with Canada, which could impact Canadian gas exports to the United States. In my view, this scenario is unlikely to materialize, but that hasn't stopped speculators from skillfully exploiting the narrative to drive prices beyond any reasonable level. From a technical perspective, nat gas is currently hovering around the critical pivot level of $4.25, a key battleground where buyers and sellers are actively engaged. This price point has emerged as a major inflection zone, with traders closely watching whether the market can establish a firm foothold above it or if downward pressure will take over. If prices manage to hold above this threshold, it could signal growing bullish momentum, encouraging buyers to step in and drive the market higher. In this scenario, a push toward the next resistance level at $4.50 becomes increasingly likely. A break above $4.50 could further strengthen the bullish case, potentially opening the door for an extended rally as market sentiment shifts in favor of higher prices. On the flip side, if sellers gain the upper hand and manage to drag prices below $4.25, it could indicate a weakening market structure, exposing nat gas to further downside risks. In this case, attention would turn to the next major support level at $3.75, a critical area where buyers may attempt to defend against a deeper pullback. A decisive move below $3.75 could accelerate the decline, potentially leading to an extended period of price weakness as bearish momentum takes hold. Overall, the $4.25 level remains the key pivot point, and how the market reacts in the coming sessions will likely determine the short-term trajectory for natural gas prices. I'd love to hear your thoughts in the comments, whether you think I'm off base or right on target. Please like, subscribe, and comment to support the channel. See you in the next one.